Welcome to the deep dive. You want to get smart fast, so let's jump straight in.
Let's do it.
Today, we're tackling something called the wheel strategy. It's a financial technique using options.
Right. Designed for income generation and maybe managing some risk in the stock market.
Exactly. Could be useful if you're thinking about retirement returns and maybe you've got, say, Rs 20 lakh set aside for trading like in our source material.
Yeah, that capital level comes up.
So our mission today is simple. Give you the core idea without drowning you in jargon.
Basically, it boils down to two main steps. First, selling put options that are out of the money.
Meaning below the current stock price.
Correct. And then, if you end up buying the stock because of that put option.
Which can happen.
Which can happen, yes.
Mm-hmm.
Then you move to phase two, selling covered calls against that stock you now own.
Got it. So let's break down phase one. Selling these puts, what's the goal?
The immediate goal is income. You collect a payment, called a premium, right up front.
For promising to buy a stock later if it drops to a certain price.
Exactly. Ideally, a price you're comfortable with anyway, often near a support level.
Okay, so what if the stock just stays flat or goes up?
Then the put option you sold usually just expires worthless. Nobody wants to sell you stock at your lower agreed price if the market price is higher.
And I just keep the premium I collected.
You keep the premium, free and clear. That's the ideal outcome for pure income generation in this phase.
Nice. But, okay, the flip side, what if the stock does fall below my strike price?
Then you could get a sign. The person who bought the put from you can exercise their right. And, well, you have to buy the stock at that strike price.
Okay. But you mentioned the premium earlier. Does that help?
It absolutely does.
Yeah.
Because you received that premium up front, your effective purchase price is actually the strike price minus the premium you received.
So even if I have to buy it, I'm getting it at a slight discount compared to the strike price itself.
Precisely. Which is why some people see this as a potentially lower risk way to enter a stock position compared to just buying it outright at the market price.
Because you pre-select your potential entry point and you get paid a bit while waiting.
You got it. And you're aiming for those support levels, places where the stock has historically stopped falling and maybe bounced.
Right. You mentioned that Rs 20 lakh figure again. That amount allows trading in bigger, perhaps more stable stocks.
Generally, yes. It gives you the capital to handle potential assignments on, say, nifty 50 stocks. Our sources mention examples like Reliance, HDFC Bank, ITC, TCS, more liquid blue chip names.
Okay, finding those support levels. How do you do that? Is it technical analysis?
It often involves some basic technical analysis, yeah.
Yeah.
Looking at historical price charts, identifying levels where buying seemed to step in before.
Like a floor the price didn't break through easily.
Yeah, exactly. Or using things like moving averages, the 50-day or 200-day average price can sometimes act as support. Fibonacci levels are another tool some traders use.
So say Reliance is trading at Rs 2,900. Where might I look?
You might look at past lows or maybe a key moving average. Perhaps you identify Rs 2,800 as a potential support zone.
And then I'd sell a put option with a Rs 2,800 strike price, maybe a bit lower.
You could.
Yeah.
Often people look 5–10% below the current price. So selling the Rs 2,800 put when the stock's at Rs 2,900 fits that. Let's say you sell a monthly put.
Okay, give me some numbers.
Maybe that Rs 2,800 put for next month gives you a premium of, say, Rs 15 per share, if the lot size is 250 shares.
That's Rs 3,750 upfront.
Correct. If Reliance stays above 2,800, you keep that. If it drops, then you get a sign.
My effective price is Rs 2,800 minus Rs 15, so Rs 16,785.
Exactly. You bought it, but at a better price than Rs 2,800.
And managing capital, if I do this with multiple stocks.
Yeah, you need to track your total potential obligation. Like one Reliance put at 2,800, maybe one HDFC Bank at 1,600, one ITC at 280. You add up the total value if you were assigned on all of them.
That could be a significant chunk of the Rs 20 lakh. The example calculation was around Rs 19.16 lakh potential obligation.
Right, so you always need to keep some cash aside. Don't commit everything. You need a buffer.
Okay, that makes sense. Now, let's say I did get assigned on Reliance. I own the shares at an effective cost of Rs 2,785. Now what? Phase two.
Now, phase two, selling covered calls. Since you own the shares, you can sell someone else the right to buy them from you, but at a higher price.
So I'm collecting premium again, but on the other side of the trade.
Exactly. You might sell a call option with a strike price above your Rs, 2,785 cost basis, maybe Rs 2,900 or ours 2,950.
And if the stock price goes above that call strike price,
Your shares could get called away. You sell them at that higher strike price.
so my profit would be the difference between that sale price and my effective buy price, plus the call premium I collected.
And the original put premium, too. You add all those premiums in.
Okay, that sounds like a good outcome.
Right.
What if the stock price doesn't reach the call strike by expiration?
Then the call option expires. Worthless, you keep the premium. And importantly, you still own the stock.
And I can just sell another call option for the next month.
You can. That's the wheel aspect. You keep selling calls, collecting premiums, until the shares eventually get called away. Or if the stock price falls again, you just hold the shares and continue selling calls, maybe at lower strike prices if needed.
So it's a continuous cycle, potentially. What are the key risks or things to watch out for?
Well, position sizing is crucial. Don't bet the farm on one stock. Consider stop losses, maybe if the stock you own falls too far below your cost.
Like maybe 10–15% down?
Something like that, depending on your tolerance.
Yeah.
Also, keep an eye on volatility. The VIX index, maybe. Higher volatility usually means higher option premiums, but also more risk.
Liquidity, too, right?
Right.
Need to be able to trade these options easily.
Absolutely. Stick to actively traded stocks and options. And don't forget costs, brokerage, taxes like STT, and capital gains. They eat into profits.
What about expected returns? Is it like 1% a month, 2%?
It varies wildly, but aiming for, say, 1–3% monthly premium on the capital at risk for the puts is something people talk about. Similar for calls. Our earlier example with Reliance and HDFC Bank puts was about ours 13,350 potential monthly premium.
But the risks are real. Downside risk if the stock tanks after you buy it.
Definitely. Assignment risk getting stuck with stock you didn't necessarily want long term.
Opportunity cost, too, right? If the stock rockets up and you sold a call, you miss some upside.
Yes, your gains are capped when you sell a covered call. And just general market risk, of course.
Briefly, why do the wheel instead of just buying stock and selling covered calls from the start?
The wheel gives you that initial phase of income before owning the stock. You might get a discounted entry if assigned. It forces a more disciplined entry, potentially tied to support levels.
But the downside is that assignment risk and needing the capital ready.
Exactly. Covered calls alone assume you already own and are happy holding the stock long term. The wheel is more about actively generating income around entry and exit points.
So wrapping up, the core idea is using option selling. Puts first, then calls if needed to generate income, potentially buy stocks you like at a discount near support levels. A structured approach.
That's the gist of it. A methodical way to interact with the market using options.
Okay, we promised a shortcut to understanding this, drawing on the info we had. Hopefully that gives you a solid foundation.
It covers the mechanics.
Here's something to think about. How much does really understanding technical analysis, those support levels we talked about, and truly knowing your own comfort with risk impact your success with a strategy like the wheel? And are there other risk management tools beyond just stop losses that might fit well with this?
Good questions to ponder.
Definitely food for thought. Thanks for diving deep with us today.